I've been seeing a lot more videos and social media posts about this new ETF called OMAH. The Vista shares target 15 Berkshire Select Income ETF. People are buying it because it supposedly lets you invest with Warren Buffett while earning monthly income. But this has gotten under my skin because I think a lot of investors are piling into this ETF without understanding exactly what they're buying. So let's check out OMAH and why Warren Buffett and Charlie Munger would hate it. And it's probably making Charlie Munger swirl in his urn right now. OMAH launched on March 5th, 2025, and it has already accumulated over $100 million in assets, and it is growing fast. Now, the fund has two components. First, it invests in Berkshire Hathaway shares, plus roughly the top 20 stocks in Berkshire's portfolio. And then secondly, it uses covered call option derivatives to generate a targeted 15% annual yield paid out monthly. Sounds amazing, right? You get Buffett stock picking plus monthly income. But there's a massive catch that I think most investors are missing. So before I share the problems with OMAH, I want to share something with you that Warren Buffett wrote in his 1987 annual shareholder letter. Quote, "I find it uncomfortable when friends or acquaintances mention that they are buying X because it has been reported incorrectly that Berkshire is a buyer. However, I do not set them straight. If they want to participate in whatever Berkshire actually is buying, they can always purchase Berkshire stock. But perhaps that is too simple. Usually, I suspect they find it more exciting to buy what is being talked about. Whether that strategy is more profitable is another question." And Warren has maintained this position for decades. If you want to invest like Warren Buffett, just buy Berkshire stock. He set it up specifically so that investors like you and I could benefit from his investment decisions. And as he said, buying Berkshire might seem too simple, but when has simplicity in investing been a bad thing? So here's the biggest issue I see with OMAH. As of the fund's most recent distribution, 95.80% was estimated to be a return of capital. That means they're not giving you income or profits. They are literally just giving you back your own money and calling it income. Now imagine you have $100. You hand it to me and I hand you back $15 over the course of a year, or $1.25 each month. Then I say, "Look at this amazing 15% yield I'm generating for you." That's not yield. That's just me giving most of your own money back to you, where only about 4% of that is actual income. I can already hear what many of you are thinking. You'd say, "But Russ, I can just take that money and buy more OMAH shares." But the problem with that thinking is when you buy more OMAH shares, you are just buying more of a vehicle that is going to give even more of your own money back to you. Now, there's also the NAV or net asset value problem. When OMAH returns capital to you, it is literally shrinking the fund's net asset value. Think of it this way. If your $100 investment pays you $1.25, but $1.19 of that is a return of capital, your investment is now worth $98.81. Each distribution shrinks the fund's assets. And with that constantly shrinking capital base, OMAH has less and less money working for you over time. Meanwhile, over there in Omaha, Berkshire is busy reinvesting and actually growing its capital base. Look at the performance difference already. According to Seeking Alpha's total return comparison, since inception on March 5th, 2025, OMAH has underperformed Berkshire by 0.5%. And then using Dividend Channel's DRIP calculator, they show a comparison since inception with dividends, or more accurately, distributions reinvested of negative 0.80% for OMAH versus that of Berkshire, a gain of 1.77%. And remember that Berkshire doesn't pay a dividend and has only paid a single dividend of 10 cents in 1967 when Warren claims to have been in the bathroom. And remember that dividends are payments made to shareholders from a corporation's profits, while distributions, which is what OMAH pays, encompass various sources including income, capital gains, or the return of capital. I think the gap over time is only going to widen because one fund is building capital while the other is constantly depleting it, right? Warren Buffett became one of the world's greatest investors and richest people through compounding, reinvesting profits at high rates over decades. And Berkshire doesn't pay dividends because, as Warren has always said, he believes he can reinvest that money at higher rates of return than shareholders can on their own. And baby, I think he's got many years of proof in that pudding. But OMAH does the exact opposite because instead of compounding your money, it's constantly returning your capital to you. And this undermines the entire Warren Buffett philosophy of long-term compounding. Another issue with OMAH is the high expense ratio of 0.95%. Now, they've got people behind the scenes pulling levers and pushing buttons, so because of that, they're charging you nearly 1% annually to mostly give you back your own money while limiting your upside potential. If you bought Berkshire directly, you'd pay zero ongoing fees. However, that 0.95% drag really adds up over time. Now, about how OMAH generates that supposed income through option strategies. In 2002, Warren Buffett famously warned about derivatives when he wrote, "In our view, however, derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal." And what is OMAH's entire income strategy built on? Derivatives, specifically covered call options. A covered call strategy means selling call options against stocks you own. You collect premium upfront, but if the stock rises above a certain price, you must sell at that price, which is capping your upside. This means in strong bull markets, when Berkshire and the stocks it holds are performing their best, OMAH holders could miss out on much of those gains. So why would Buffett and Munger hate this ETF? Well, here it is in black and white. It goes against their philosophy of compounding capital. It uses derivatives, which Warren called financial weapons of mass destruction. It limits upside potential in bull markets. It charges high fees for something that could be done for free by just buying Berkshire stock. And it's marketed as investing with Buffett while doing the exact opposite of what made Warren Buffett successful. It reminds me of the 2013 annual shareholder meeting because I'm a nut and part of a cult called Berkshire, and I've listened to every annual meeting since 1994. Twice. And Warren said that anything Wall Street can sell, it will sell. And I think OMAH perfectly demonstrates a product that Wall Street created that entices retail investors with high yield, but goes against everything that Warren Buffett fundamentally stands for. Again, I can hear some of the comments that some of you have. Hey Russ, what about retirees who need income? I hear you, and that many retirees need regular income, but there are much more efficient ways to get it. You could own Berkshire directly and sell fractions of shares when you need cash, which gets you the same result without the high fees and the capped upside, plus you control exactly how much you need and when. I mean, think about it. Would Warren Buffett tell retirees to buy a fund that uses derivatives to cap their upside and slowly gives them their own money back? He even addressed this argument and gave an example in his 2012 annual letter. I'll summarize it, and I would recommend that you read it. But Warren said reinvesting all earnings and selling a small percentage of shares each year can lead to greater long-term wealth and higher annual cash flow than relying on dividends, because this approach avoids dividend taxes and allows compounding to work more powerfully. And Buffett's example shows that after 10 years, the shareholder who sells a small portion of shares annually has more cash and a higher total share value than one who takes regular dividends. But Russ, the performance difference isn't significant yet. Of course it isn't. OMAH just launched in March of 2025, but I guarantee this gap is going to grow over time as the math catches up, because every month OMAH's net asset value is going to get smaller through the return of capital, while Berkshire's value keeps compounding. It's like a race where one runner has their shoes tied and the other is in an Indy car. Hey Russ, what if I want both Berkshire exposure and income? There's a simple solution that's likely to outperform OMAH. Buy Berkshire directly, and if you need income, Sell a small portion periodically. You can also split your money by putting 80% in Berkshire and 20% in a quality income fund like SCHD or VYM. Both approaches avoid the return of capital problem, high fees, and capped upside that come with OMAH. You get the same exposure with better long-term results. If you want to invest like Warren Buffett, keep it simple and just buy Berkshire Hathaway like he's been telling people to do for decades. I've listened to and read a lot of Warren Buffett, and he would say, just keep it simple because the simplicity investing over time will outperform many complex strategies. Now, I wouldn't let flashy marketing or high yield numbers distract you from what really matters. Growing your wealth through compounding and not slowly giving your capital back to yourself and calling it income. Always look and think about total return and not just yield. Now, in this floating little box next to my head, I did a video, dear dividend investing viewer, just for you of Warren Buffett's example from his shareholder letter of dividends versus no dividends and which one comes out ahead. So if you click that floating little box next to my head, I'll tell you all about it there.